It's been an absolute bloodbath in the stock market. Elon Musk became the first person to ever lose $200 billion. Peloton crashed 90%, and they're not the only ones. 45 companies on the Russell 300 were down 90% or more in the last year. Tesla's always in the news, but they're not even the top 3 companies that destroyed shareholder wealth. Amazon's market cap plunged $805 billion in 2022. Both Apple and Microsoft wiped out $700 billion in value last year. Facebook, negative 64, PayPal, negative 62, AMD, Netflix, they're both only worth half of what they were a year ago. And the list goes on and on. The sad part is this isn't just some story on the news. If you have a 401k, IRA, or hope to retire someday, this affects you personally. If you're like most, your accounts have suffered over the last year, but it doesn't have to be that way. You don't have to sit helplessly as you lose more and more money. But be warned, in pop culture, short sellers are often vilified and portrayed as predators. The question asked, is shorting bad or evil? Author goes on to write, personally, I don't like shorting. The idea that you can sell something you don't own is somehow unethical and morally disturbing. If I had to guess why many in the general public are against shorting, it's because misery loves company. When they see their accounts getting lower and lower, they burn with anger to think someone's out there profiting from their misery. They'd rather buy and hold, losing money all the way down, pointing fingers, instead of learning how to be more active in the market. Why? Because knowing how to trade properly would make them responsible for their own profit and loss. They'd rather be ignorant so long as they can claim to be victims of unfair short selling and greedy hedge funds. I could make an entire video about how there's nothing illegal or immoral about short selling. In fact, I can think of so many benefits short sellers provide to the general market. Just a few are increased liquidity, tighter spreads, exposing fraud, and hedging risks. That'd take another 20 minutes and won't get into that now. The point is, don't pay attention to the naysayers, but keep an open mind. The truth is, learning more about short selling will help you not only in retirement, but you can make money now in the short term. For me personally, I've never had a moral dilemma about short selling. I used to play a lot of poker. It's a competitive game. There are people who win and people who lose. But as long as I'm competing according to the rules, there's nothing wrong with making money. That's the whole point after all. When it comes to trading, it's the exact same thing. There's nothing against the rules about short selling. But my biggest concern was, don't stocks almost always go up? What's the point in short selling then? Ask a random person on the street and they'll tell you a stock market recession is a rare occurrence. For example, think about the cause of the last 2 recessions, COVID and the mortgage crisis. COVID throws us into a worldwide pandemic. People are forced to stay home. Businesses are shut down. Massive amounts of money are printed. Inflation levels we haven't seen in years. Now let's go back to 2007, 2008, the global financial crisis. Millions of people can't pay their mortgage. Unemployment is close to 10%. Greed of the bankers is crashing the world economy. It's easy to understand why the stock market would go down when there's so much uncertainty and turmoil across the globe. But when life is normal, most people don't expect the stock market to struggle. Think back to before 2008 and guess when the most recent stock market crash was. Most people would jump all the way back to 1929 and the Great Depression, not knowing there have been so many bear markets all along the way. Here's an article from 2020, right as COVID is kicking off. The bull market has been raging for 11 years. It's been smooth sailing for investors for over a decade. People are expecting market growth year in and year out. It's easy to forget the time between the global financial crisis and COVID was the exception rather than the rule. It might surprise you to read the bull market we just came out of was the longest, not in a generation, but in the entire history of America. To put it in context, I'm going to quickly run through all the bear markets of the 20th century. But before I do, know the end goal isn't a history lesson or trivia. I want you to start realizing you're likely to go through many more bear markets in your life, and it's better to start learning now how to identify them, prepare, and profit from them. The Dow Jones Industrial Average was created in 1897. 3 years later, 1900, the market went down 31%. 3 years later, it fell 37%, and 4 years after that, the market plunged 45%. In the span of 1909 and 1919, there were 4 bear markets, tanking prices anywhere from 23 to 46%. 4 years later, down 18%. 3 years later, the market lost 16%. And of course, 1929 crashed 90%. Just when people are getting back on their feet, the market corrects 24%. Then 1937 is the start of a 4.5-year bear market, eroding 51% of market value. 1946 was the beginning of another 3-year bear market, followed by drops in 1957, 1960, and 1962. It doesn't stop there. Stocks go down in 1966 and 68. Lost 46% in 1973. 77, 84, 87 were all down years. And of course, most people have heard about the tech bubble that popped in 2000, crashing the NASDAQ 72%. Adding everything together, on average, there's been a bear market every 4 years. I hope you're starting to see that it doesn't take a worldwide pandemic or the collapse of the entire banking system to cause stocks to go down. Declines in prices are something you're going to see over and over again. But it's up to you if you want to understand short selling, learn how to take the necessary precautions, and ultimately make money from it. Now, what I want to do is explain the mechanics of what's actually taking place when someone shorts a stock. For context, we've all heard you want to buy low and sell high. It's an idea everyone understands. Say someone's an antique collector and buys a set of silverware at a garage sale for $100. She lists it on eBay for over $2,000. Buy low, sell high, make a profit. The concept of shorting is more vague. In a way, it's like a magazine publisher selling you a yearly subscription. They get all the money up front, but they haven't written any articles yet. They owe you and will eventually have to give you what they promised. When it comes to short selling, what basically happens is he borrows shares he doesn't own and sells them right away. He wants price to go down so he can buy them at a lower price and make a profit. Let's go to the charts, see how it works. Here's a typical long example. You want to buy low, sell high. You buy at $50, sell at $120, and make $70. Price comes back down and you do it again for a total profit of $140. At first, it might look like you made maximum profit. You bought at the very lowest point, sold at the very top twice in a row. But you could have actually doubled your profit. We ignored the red parts of the graph. This is where shorting comes in. Shorting a stock is the opposite side of the coin. Sell high and buy low. The twist is you're selling something you don't even own, only to buy it back later. It sounds confusing, but it'll make perfect sense by the end of the video. Going back in time, we have $1,000 in our account. Price is at $50, we buy 1 share, and our cash is now $9.50. Eventually, price gets to $120 and we sell the share back. We don't own anything, but we made $70, and now our account grows to $1,070. It's important to note that selling the share we own and going short are 2 separate transactions. Before, we were long because we bought 1 share. After selling the 1 share, we're back to flat at 0. At this point, we're not long or short. We borrow 1 share at $120 and immediately sell it on the market. $120 plus the $10.70 we already have in our account is $1,190. Price goes down and we want to close the trade. We buy back 1 share for $50 and return it to the original owner. We initially cashed in $120, but only had to give back $50, which leaves us with a $70 profit. In order to short stocks, you need to have a margin account, which allows you to use the equity and securities in your account as collateral for borrowing. So in this example, if you want to short $1,000, you put up $500 and your broker would put up the other $500. Not every stock is available to short. Most brokers won't let you short stocks under $5 a share. There's also special rules if the stock has already dropped 10% in a day. In that case, you can only short at the bid on an uptick. At other times, maybe some bad news came out about a company and everyone's trying to short it. But you can only short if someone is willing to lend you shares. If a hedge fund client also wants the shares, as you can imagine, they're going to take priority over us retail traders. Let's assume we're good to go and talk about what happens next. Here we have a $10,000 account, and since the broker will put up half the money, we have $20,000 in either buying or selling power. Current price is at $10, so we decide to short the maximum, which is 2,000 shares. Not that I'd recommend going all in, but let's go with it for now. Broker borrows the shares and immediately sells them for $20,000 cash, which is held in escrow. When we're short, we make money when the stock goes down. Stock goes from $10 to $9. So we're in profit $1 per share times 2,000 shares. So we have an open profit of $2,000. Stock keeps moving in our favor. From 10 to 8 is $2 times 2,000 shares means we have a running profit of $4,000. Now we want to close the trade. We opened by selling 2,000 shares, so we have to buy back those 2,000 shares at the current price. In total, we initially sold 2,000 shares at $10 and added $20,000 to our account. Now we use $16,000 to buy back 2,000 shares at $8, which leaves us $4,000 profit. We started with $10,000, and after everything is squared away, we now have $14,000. When we're short, we're betting the stock will go down. The other side of the coin is we lose money when the stock goes up. So if we shorted 2,000 shares at $10 and price goes up to $12, we lost $2 per share times 2,000 shares means we're in the hole $4,000. Let's see what happens when the trade is a big loser. If you recall, $20,000 was deposited in our account right away when we sold 2,000 shares at $10 each. We also had to put up half the money in escrow, which was $10,000. So in total, we have $30,000 available to us when we have to buy back the shares. Here, price has gone from $10 all the way up to $16. We want to cut our losses and get out. The problem is we need $32,000 to close the position. We only have $30,000. We're $2,000 short. I don't think you'll be surprised that Goldman Sachs and Morgan Stanley aren't in the business of going into their own pocket to cover your loss. So they have protections in place to cut the trade before it ever gets to that point. Before we saw we had to put up 50% of the money at the beginning, but we also have to maintain 30% equity for the entire trade. The broker would never allow the trade to run up to $16. When price rises to $11.50, that means we've lost $1.50 per share times 2,000 shares for a loss of $3,000. We started with $10,000, which means we currently have $7,000 of equity. The current market value of 2,000 shares at $11.50 is $23,000. 7,000 divided by 23,000 is just over 30%. Here you see at $10, we started with the required 50% equity, but as we lose more and more, our equity gets less and less. At $15, we'd be completely wiped out. And at 16, we lost more than our entire account. When price gets to around $11.50, your broker isn't going to be sitting on their hands wondering what to do. They'll contact you with what's known as a margin call to bring your equity up to the 30%. You have three options. First option is you can deposit more cash and leave it in cash. Second is you deposit cash and you use it to buy back some of the shares. Third is you're free to do nothing. but your broker will go ahead and close the position for you to avoid the losses getting bigger. I made a spreadsheet that I'll link below to go over the margin call. As we saw before, we start with $10,000, buy 2,000 shares at $10. No profit or loss, and our count is at 50% initial margin. Price goes up to $11. We're down $2,000 and margin is at 36.4%. This is above the 30%, so our broker is not going to call us asking to deposit more money. At $11.50, we're almost at the 30% limit, but not quite. Price goes up to $11.55, which dips below 30%. At this point, we have two options. We can deposit and leave an extra $30 in our account. Account equity would go up $30, we'd be okay for now. Second option is we can deposit $100, buy back 9 shares at $11.55, and this would raise our account to 30%. Let's say overnight the stock gapped up to $12, maintenance dropped to 25%. If we want to keep the position open, we either have to deposit and leave an extra $1,200 in our account, or deposit $4,000 and buy back 333 shares. Link in the description below if you want to play around with the spreadsheet. Just because we have $20,000 available doesn't mean we should use it all. I have a playlist on risk management, setting your stop loss, taking profit, and psychology. These are crucial when going short. In case you haven't seen them yet, let's go over a quick example of how to calculate trade size and a potential profit target to shoot for. This is not how you want to look for a short sale. We're not trying to guess where the absolute top of the market is. Don't be the person who shorts a stock while it's in a strong uptrend. Instead, this is what we're trying to do. Regardless of whether you use price action or indicators, the goal is to find an avalanche already in motion and ride the momentum. Chart here has been in a year-long slump. We get a little pullback to an area where support may be turning into resistance. Go over to the left and select short position. Double click, and before we said we'd enter at $10 and the margin stop out was at $11.50. Stop is $1.50 and we want at least 2 to 1 for a take profit of $3. Going back into the options, our account started at $10,000. We want to risk 2%. Before we shorted 2,000 shares, but if you notice in the box, it's telling us to only short 133 shares. Working out the math, if our account is $10,000 and we're risking 2%, we're okay with losing up to $200. A stop of $1.50 times 133 shares is a loss of $199.50. So the math checks out. As you can see, when we got margin called, we lost 30% of our account. One of the points I've tried to hit over and over again in my previous videos is losses are inevitable. There's nothing wrong with an idea not working out. When traders go broke, they typically aren't bleeding out over the course of 50 or 100 trades. It's usually a few massive losses that put them in a hole they can't dig themselves out of. Save yourself future headache and get a grip on risk management and setting your stop loss now. In the profit taking video, I went over one way to set your profit target when going long with the ABC pattern. Let's see how it changes when going short. In an upswing, price is making higher highs and higher lows. Click on ABC and our take profit will be halfway between the two upper lines. We're shorting in an already established downtrend. So now A is the high, B is the low, and C is the lower high. Use the trend-based fib extension tool, click on ABC, and take profit is between the yellow and the white line. Don't ever be in a rush to get into a trade. If you missed the first one, just wait. Here we've identified a new ABC with a high, low, and lower high. Take profit in the middle. Before we wrap up, let's address the elephant in the room. I'm sure you've heard this. People say when it comes to shorting, there's the risk of infinite losses. What they mean is when you buy a stock for $10 and the company goes bankrupt, the most you're going to lose is $10. However, if the company is wildly successful and the stock goes to $1,000, you're going to be down $990. On the surface, that may be a little scary, but let me ask you a question. Before the Amazon stock split in March of 2022, it was trading for around $3,000. If you own Amazon, no matter how much you love the company, are you really going to hold the stock to zero? Somewhere along the line, maybe it's $2,500, maybe it's only $500, but sooner or later, I'd hope you cut your losses and get out. No one in their right mind is going to take the maximum loss. In the same way, when you short a stock at $10, are you really going to stay in the trade as it shoots up to $1,000? Number one, it doesn't make sense. Number two, as we saw before, your broker would close out the trade long before that. Whether you're going long or short, we're always going to have a stop loss in place, and we're only going to be risking a small percentage of our account on any one trade. Whether it's driving a car, getting on an airplane, or short selling, everything in life has risk. But there are ways to do them safely. As I mentioned, I have an entire playlist on how to control your mind when the trade is going against you, ways to manage your risk, and also some tips and tricks on how to take profit and set a stop loss. Click the link here, and I'll talk to you soon.